Time now for business. Kate Moody's here. The British government's trying to contain the damage from this weekend's announcement that Nissan, the car manufacturer, is pulling out of a major investment in northeastern England.
Yeah, absolutely. The car maker said over the weekend that it would be moving production of its new X-Trail model back to Japan, citing Brexit uncertainty as one of the reasons. Now, a letter released this Monday, but written back in 2016, shows that the government had promised to protect Nissan from any fallout linked to the UK's exit from the EU and offered some €91 million in financial support. This in an effort to secure future production at Nissan's plant in Sunderland, where some 700 jobs are now at stake. Prime Minister Theresa May was planning a conference call with some 50 bosses of major international companies this Monday to try and reassure them that a withdrawal deal is within reach. But Nissan's announcement, on the heels of similar warnings from Jaguar Land Rover, could spell trouble for Britain's auto industry and the country's manufacturing sector as a whole.
The impact will be staggering. You've got to remember, it's not just 7,000 employees at Nissan. You're talking 30,000 plus employees that feed in to Nissan and subsidiary businesses around the area. And people, if you start to see job losses, you start to see impact on smaller businesses. You know, the impact really, if that was to happen, potentially could be catastrophic.
Meanwhile, business between Japan and the European Union has gotten easier after their free trade deal took effect on Friday. Among other sectors to benefit, Japanese cars exported to the EU will be seeing tariffs drop to zero over the coming decade. During a visit by German Chancellor Angela Merkel to Tokyo, Japanese Prime Minister Shinzo Abe said their economies would boost cooperation on issues of free trade, resisting both Donald Trump's nationalist approach to trade and the risk posed by Brexit.
Japan and Germany will lead the world's largest free economic bloc, which was born on the first day of this month thanks to the EU-Japan Economic Partnership Agreement. In order to do so, it is necessary to minimise the risk of Brexit on the European and world economy. We must avoid a no-deal Brexit.
Let's check in on the day's trading action. Now, Wall Street is trending upwards as investors wait for what are expected to be strong results from Google's parent company, Alphabet. Shares of the home goods manufacturer Clorox up about 7% this hour after fourth quarter earnings beat expectations. The major European indices had a mixed, fairly muted close. The auto sector was down about 1%. Ryanair shares slipped 2% after Europe's biggest air carrier reported its first quarterly losses in 4 years. Oil prices, meanwhile, are sliding, having reached their highest level of the year earlier on in the session. US WTI down about 1.75%. Australia's banking and finance sector is in line for a shakeup, and a number of its executives could face criminal charges. A year-long public inquiry found that banks had committed a range of misdemeanours, ripping off consumers for years. Luke Schrago explains.
Charging dead customers finance fees, charging for services not provided, selling inappropriate products to the vulnerable, and bribery for mortgage business. Just some of the evidence given in an 11-month inquiry that's left the Australian finance sector's reputation in tatters.
It's a scathing assessment of conduct driven by greed and behaviour that was in breach of existing law. The price paid by our community for this misconduct is immense.
The government-commissioned inquiry referred 24 instances of misconduct to regulators for further investigation and potential prosecution. It also made 76 recommendations, on all of which the government said it would act, including establishing a compensation fund to help those who lost out on bad financial advice, closing legal loopholes and increasing consumer protections. Anticipating closer scrutiny, banks have been tightening up their act in recent months.
Banks understand that these failures have caused deep hurt, suffering and heartache. Banks accept full responsibility for these failings, and they know that they must now change to ensure that this never happens again.
The inquiry, however, didn't go as far as recommending punishments or splitting up a sector worth $291 billion, leaving such decisions to regulators, who themselves have been accused of working too closely with banks. Whatever the Australian government decides to legislate, though, there's not much time for them to do so. National elections are due in just 4 months.
Canada's biggest cryptocurrency exchange says it's unable to pay its users some $190 million after its founder died without leaving behind the password needed to release the coins. Quadriga CX's 30-year-old founder and CEO, Gerald Cotton, reportedly passed away unexpectedly on a trip to India in December. His company has been unable to crack into his encrypted laptop. According to his widow, Cotton had sole responsibility for handling the funds and coins, which are now unavailable and may be lost altogether. Quadriga has asked for creditor protection to help deal with this, with what is likely to be a large number of claims, Mark. Of course, a lot of speculation about the circumstances of his death, why he would have such complete control over such a huge investment, and certainly another reminder of the dangers of investing in that cryptocurrency world, which remains unregulated.
Always dealing cash, as my grandmother used to tell me. Kate, thank you very much indeed. I can't begin to get my head around what's going on with that cryptocurrency thing. It's absolutely remarkable, isn't it? Thank you, Kate. Kate with the business. The other